Obviously, when we're talking about finding opportunities, we, as traders, need to institute a set of core values that define what we want to trade. What in the chart is exactly going to give us the highest probability setup. So when we go to look at our unusual option activity, we've got a highly probable chart that's going to increase what we have to go and look for, what to do our research on. Today, what I'm going to be speaking about is the madness we've seen in the last few months. I call it March market madness, of course. Now, this is going into April now as well. And we have some very unique situations going on in the stock market right now that we feel really comes around once a decade, and that we are here once again. And there is a significant opportunity to make money from this. So I'll be going through the rationale behind that, and of course the strategies that we're implementing, as well as the stocks and options that we're trading right now to maximize that opportunity. So of course we will be talking about live stocks, and towards the end we'll be taking your questions about maybe some stocks or positions you'd like us to analyze for you, but it is of course for educational purposes only. Okay, so a couple of leading statements, and maybe some of the other presenters have talked about this already, but most people fail in the market not because they're ill-educated or that they are not smart people. It's because they don't take action. And the reason why most people don't take action, again, it's not because they're lazy or anything like that. It's because they have no confidence in the rules, or they don't have any rules at all. So this is one of the key things that that we worry about. And I'm just going to change speaker there. Can everyone hear me clearly? Change the microphone here. Okay, terrific. Wonderful. Okay, so yeah, so most people don't have rules. And again, so they don't have those core qualities that they're following for every trade. And that leads to big psychological problems. So either they don't believe the rules that they're being taught, or they don't believe the market is predictable, or worse, they believe these things, but they don't believe that they can do it. So this is some of the kind of the myths or problems that we're going to also try and overcome by delving into the details today. Now, remember at the end of last year, everyone was talking about this Christmas rally, that the market, despite its pullbacks in October, was healthier than ever, and things were all good, and everyone's going to get a big bag of goodies for Christmas. Then what happened in January? Of course, we crashed straight away. How many people here in the room were actually attendees in our Capturing the Crash Big One special back in Christmas and again in July? How many people have heard me talking about this before? Okay, so for those of you who are new, this is these situations that are building right now are we did a big Christmas special talking about the fact of why the market was going to plummet in January, and this was the slide we had up. We also did this again in July of last year, talking about why the market was going to plummet in September. The market did then. We've been 100% accurate in picking every reversal of the market since 2008, every big correction we have anticipated, and it is using the rules I'm going to show you today. So the thing about big rallies in the markets is that obviously the stock market is the best business, the best run business in the world. And it's there not to help you, it's there to help the big money, the smart money. That's why 1% of the world has 99% of the wealth. And when markets are topping, this is when they want to entice you that the things are better than ever. So when I logged into CNN Futures yesterday, and I read glory markets, markets are at the highest level they've been ever in 2016. That scares the hell out of me. So when you're looking at all of the different things that are out there to entice you into making an investment, keep in mind that most of it is wrong. Statistically speaking, there was a study done on economic theories by well-known economists and so forth. They found that over a 2-year period, almost all of them were wrong. Almost all of them. They also did a study of people that presented on shows like BNN and CNN Money and these kind of talking head programs. They found that over 70% of the predictions that the experts were making were wrong. So as a trader, where do we go to start getting good ideas when we know that the majority of the ideas we get will lose us money? Well, to do that, we have to start looking at things we can quantify. Again, things we can measure, that we can look at in a chart and see through the you-know-what and say, right, does this hold water, and how can we measure that every single time the same way? So let me start off by telling you the background for some of the ideas I'm going to present, and then we'll go into how we measure those ideas to give us a trading decision, not a gamble. So firstly, let's talk about the ideas that we presented back in July, back in January, and what I'm going to present to you again right now. In the background, it's no secret that the Asian economies have been in real strife. We're seeing, if you look at the Nikkei, I mean, it dropped about 3.5% on Friday. If you look at the Asian economies, they were weak. The German DAX was down significantly. All the markets overseas are starting to turn down. The problem is that when we start to see, if we do see a collapse in this market, and we had it in January, but we were able to recover from that, some believe, as I do, that it was a massive short covering. And of course, by the time that everyone thought the market was going to crash at the bottom in February, that's when it goes back up. So possibly just a big short covering. So what happens is if markets do start to correct, what we're going to start seeing is bankruptcies. Highly leveraged companies that just run out of credit, and the banks can't finance them anymore. Companies start finding it difficult to borrow. Consumer credit contracts. This is what we know is a credit crunch, right? And as people start to sell, this has a major implications for ETFs. Investors and traders no longer accept heightened risk in the market, and when people start to sell, it creates a bubble that bursts. And who here has seen the movie The Big Short? I watched it actually for the first time a couple of weeks ago. And anyone here watched that movie? If you haven't, it's excellent. I definitely recommend it. It will re-engage why we love trading. It's just beautiful. And it talks about, looking into you're scraping away the BS. The people who predicted the housing crunch and made billions of dollars, they didn't make that money because they were reading the newspaper and saying, oh yes, I agree with that. They were going completely against the trend. They were going against what Greenspan was saying. They were going against the federal government. They were going against the housing market of the United States of America, which was felt to be the most stable thing there was. So what we need to do is not see, well, do other people agree with this? We have to look at how we measure this and whether this is actually another big shortcoming. Because the bubble that's existing in the market now is about $600 trillion of speculated value. In other words, taking $10 and borrowing $10 million against it. That $10 million doesn't exist. It's paper. It's speculation. It's backed up by the original $10 note. That's the speculated value in the economy now. So when things burst, that's how much rapidly disappears. And because of this, price-to-earning ratios are called into question. High price-to-earning companies therefore suffer. And companies go into survival mode. They cut back. And if you're reading the news, I think it was Intel or IBM, sorry, is bracing to start laying off employees. I read that in the news yesterday. Big companies into survival mode. They talked to the amount of new jobs being created has gone down. And even the jobs that are created, the jobs that are available, they're not hiring for them. And that's the substantial divergence that I've been seeing in the data over the last few months, is that although the amount of job openings had increased something like 40%, the amount of hirings had not changed. So jobs are there, but they're not being filled. So this is some of the data that you read through. And of course, we look at this massive rally we've had, and we say, well, how true is it? Are we in a bear market, or are we truly in a bull market? Well, let's have a look. Let's start looking at things we can measure. And this is one of these slides here sourced from Inside a Cow. And this represents all of the insider buying versus selling over the last 30 days. Now, just in case you have difficulty with color, the red is selling. The big bars are the red ones. So when we talk about whether this is a short covering market where traders have been able to make great money going long over the last few weeks, or whether this is an investors market where people are looking to position long-term into buys that they are going to hold, wouldn't you think that the people that know the most about the companies that we're investing in are the people that own the companies themselves? And if the people that own the companies themselves aren't trading, buying into their own stock, why would you? Can you imagine if I came out here and said, hey guys, I have a great trading strategy for you, something that you should really believe in, but I never traded myself. Would you want to buy that strategy? I wouldn't. So if insiders are coming out saying, believe in my stock, it's going higher, but they're selling it, I think you can apply similar logic to that equation. But that's the ratio here, massive selling versus buying. Let's have a look at the daily insider buying versus selling. This shows the dollar figure by day. And as you can see, before most big crashes, you can see that like for example, in January, for example, back in July, where we crashed in September, look at what happens to the daily insider buying. It drops down to these zero levels. And that's exactly where we're at now. Okay, but stocks have been continuing to rally. So the thing is that this is a market of individual stocks. And what we need to do is, again, start looking at where this high probability market's going next. Now, I've talked about measuring the insiders. Let me show you two other things that we can also use to measure smart money. Okay, firstly, high yield bonds. Yes, sales can be for many reasons, Gerald. However, if you own stock that you believed was going higher, 20% higher, and you needed $50,000 to rent a yacht for the week to sail around the Spanish islands. I don't know what the CEOs are using them, but selling their stock for. I prefer to put that on my Amex Black Card than sell $1 million worth of stock, knowing it'll be worth $1.2 million in 3 weeks' time. Yes, there can be reasons why people sell, but when you see that everyone, the CEO, the general vice president, the general counsel, the executive vice president of worldwide sales, then that they're all selling $2, $3, $4, $5 million worth of their own stock in around the same time, just ahead of earnings, I don't buy that at all. I don't think they all need their money that desperately if the earnings were about to be awesome. So I read between the lines, I think, and especially then you start looking at unusual option activity, you can get some real gems. So high yield bonds, HYG is another thing to look at. Now, high yield bonds represents this. It represents the smart money's faith in the stock market, in the U.S. economy, in corporate U.S. America. Because if there is a strong belief in the U.S. economy, or the stock market anyway, investors, bond traders, which are very well-educated people, will invest or buy corporate high-yield bonds. Now, if you want to see the evidence of this, check this out. So let's go back 8 years. Now, okay, The stock market crashed in 2008. So did high yield bonds. We recovered in 2009. So did high yield bonds. The high yield bonds tracked the stock market very well over that period of time. Okay, now what happens, it was right there in the middle. You can see that around 2013, mid-2013, the high yield bonds stopped going up. They stopped believing in the long-term investment opportunity in the S&P. They believe that the market has reached its true value at that point, and they start selling off. Now, what happened in 2013 that could that might coincide with this? What kind of events were happening economically around 2013 that might start to concern big money investors? Exactly, Stephanie. Quantitative easing. Quantitative easing came in, and the and smart money started going the other way, and of course Greece as well. Yes. Now, when we started to look at the market in 2000 and last year, 2015, and we saw that the S&P 500 was rallying up and away. The corporate high yield bonds were going down, 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 down. And again, at the end of the year, so we predicted the crash in July 27th, was that when we held our event, and we picked a bunch of shorts, which 80% of those went up over 500% of our 10 different picks for shorting the market. So we called that the big one. We had another big one here in December, and again, that was using the same type of strategy, and looking at shorts then going into January, and you can see again we've had that big drop. But look at the high yield bonds. Now the market has then turned around. So obviously, just like we use the high yield bonds to predict the crash, the high yield bonds are very valuable in predicting the turnaround. So as we started to see, the high yield bonds were in a downward channel. Now, what kind of pattern is a downward channel? Is it bullish or bearish? Bullish or bearish? It's bullish. Because when we talk about the direction is bearish, but when we talk about a pattern, we're not talking about where it's going now. When we talk about a pattern, we're talking about where is it telling us it's going to go next. So that's the key thing that we need to look for. Okay, now if we go and have a look at, all right, so that's broken out. That's gone higher. And that tells us in February that this market was going to steam ahead, and high yield bonds did so as well. What can you notice though now? Let's look at the S&P 500. Let's pull up the S&P. The S&P has gone straight up over these last 2 weeks. And we made all-time highs yesterday. What has high yield bonds done? What do you see HYG doing? Going down. Toppy candles. Forming a possible, where's the line here? Come on. There we go. Okay. Forming a possible what? What kind of pattern might we be forming here in the high yield bonds? Head and shoulders. Okay. Now let's look at the pattern on the S&P 500. if we actually observe the S&P 500 support, we connect the low here to the low there. There's the breakout point, and then we retest it from beneath, and we're holding beneath. What kind of pattern do we have on the S&P 500? That's right, a rising wedge, which is what? Which is bearish. Okay, so all of these things starting to make a clearer picture. So we start to say, well, what's going on here? Do we really have a market that's rallying and higher and higher and higher, that we should be taking our mortgage and putting it all into blue chip stocks? Or do we see that we have a market that is topping? Now, I'm going to share with you in a moment one other methodology of predicting extremely accurate market movements. In fact, it is accurate in predicting the S&P 500's movement up to 80% probability over the last 2 years. I went back and back tested it myself. I went through every single day on the S&P for the last 2 years. I actually did an entire lesson on this topic for Acorn students, and it was about 82% accurate at the time I did that over a 2-year period. I'm going to share that with you as a special extra today. But before we do that, let's talk about the underlying fundamentals of what we're discussing here. So the thing is that we've all heard this statement before, that the theory of insanity is doing the same thing again and again. And the questions that we have to say is, okay, you know, I think Mark Twain said that the history doesn't always repeat itself, but it sure does echo a lot. You know, the market does if we can see that we use a certain set of rules and that it predicted the crash of '08, it predicted the European Union crisis in 2010, it predicted the crash of 2015, it predicted the drop in 2016. I mean, that is a 100% win record following that set of rules. Now, yes, it may not work again, but instead of worrying about the risk of what if it's wrong, what if the strategy is wrong this time? Instead of you worrying about that, what you should be worrying about is what if it's right? And if all the data that's worked before is saying the same thing, then we need to be concerned about that. Why not start your trend line on the low? I'll come back to that in the practical part when we bring up all the charts. So how do we make our decisions? News, friends, newsletters, things we're familiar with? No, what we should be doing in terms of what I think we should be doing is making decisions based on what the charts and data tells us, and using rules. If we don't use rules, then we're only using emotions, and we start to see a stock where we get drawn into our own lives, where we buy a stock based on emotion. It goes up past our 20% or 50% stop loss, like Andrew was talking about, and we say, but I can't be wrong. I was so convinced about this idea. I'll average down. I'll buy some more. Now it's dropped. Well, now it's not even worth selling. Now I'll just hold on to it. I mean, we've all done it. And we go into a trade without a very strict plan. And the second you do that, you're lost. The second you take a trade without knowing exactly when and where you'd get out before you've even gotten in, you're screwed. Excuse my French. But that's what we need to have. We need to have rules, and that's why 95% of investors lose. It's not that coming back to our earlier statements, it's not that you can't do it. It's not that the stock market isn't predictable, because it is. It's extremely predictable. The crash of 2008 was predictable by 3 head and shoulder patterns. That's it. The entire crash and recovery rally were 3 head and shoulder patterns that worked perfectly. In other words, extremely predictable where the market was going to drop to and recover from. So coming back to the idea of the market structure of where are we now, understand that all markets follow Dow theory. We have three different types of zones. We have accumulation zone where the smart money wants to scare you out of your position, stop loss everybody out, whipsawing the stock. And the idea is if you know a stock's going to go up 50%, then you want to get everybody's stock off of them cheap, hold it there for as long as possible so you can accumulate a position before it starts to move. That's called the accumulation zone. Okay, the next zone is public participation, and that's the guts of the chart, the middle part. And that's where people start to say, oh, markets are up 10%, this stock is up 10% from its lows, 15, 20, wow, 20%? I'm going to get into that. That looks like a strong stock. That's where public participation happens. And then at the very top of the chart, you get distribution. And in the distribution zone, this is where the smart money that bought at the bottom with their $1 billion worth of XYZ need you to think it's the best time to buy so that they can sell their $1 billion worth of stock to you. There has to be a buyer, and the buyer isn't the smart money at that point. The buyer is Joe Public. And so this is when you start to hear the noise. Markets rally, housing bubble, shortage of housing supply, record highs in the S&P, blah, 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 blah. And that's called the distribution zone. So where are we at? The market, the rules tell us that we're starting to enter the distribution zone. Whether it's going to be tomorrow or the next day or the day after that or next week, we need to be prepared that if the market does turn, what we should be prepared for and how are we going to take advantage of it. What exactly are we going to scan for that gives us these potentially explosive moves to the downside? And this is the best time to capture them, is that when everyone thinks it's going up and you can buy extremely cheap puts on some stocks that when you get an earnings surprise to the downside, which could be 20, 30% move overnight, you can see stock options you'll buy at 20 cents that you can then go and sell for $2 the very next day. And I don't mind a 1,000% return, even if it was a 300% return. These are the kinds of opportunities when markets get caught by surprise. So how do we figure out when that is going to be? How do we know, how do we put probability on our side to determine when this market will crash? That's obviously the golden ticket, right? So I told you I was going to share with you a strategy that is up to 80% probability in predicting the move of the S&P 500. And does anyone, maybe who's already been through our course or familiar with us, anyone know the strategy I'm talking about of predicting the S&P 500's movement? Now, all right, well, it is my pleasure to share it with you. I don't think, yes, Stephanie, you're absolutely right. Well done, Steph, I'm impressed. Look, I don't share this with many people. It's something we don't really teach, we don't offer this as a course that's for sale. We teach it to our advanced clients in our membership. Now, the strategy is called open range. I was taught this by one of the coaches I hired about 5 years ago, and it changed my trading ever since. Now, open range is 2 specific days in the month where a very important range is set, being the open range. It's the first trading day of the month. So let's go back and say, let's go back to February. So the first trading day of the month, February 1st. Okay, so on February 1st, we set this range. So there we go. That is open range for February. Now, so that's February 1st. What we then look at is whether the market closes more than 3 points above or below that range. And depending on whether we close above or below by 3 points, that gives us the direction the S&P will be biased towards until the next open range day. So when I told you I back tested this, that meant that over 80% of the times that the market went higher or lower, it closed above that or below that, depending on which direction, by the next open range day. Unbelievably accurate. So what that means is that as soon as we saw it break negative, that told us, bang, we are going to run our capturing the crash scan, and that's going to find us the stocks that are set up for the highest probability drop. And then we'll go and short them or buy puts against them. And it did, it dropped. Okay, so then we come to our next open range day, which was the 3rd Friday of the month. So options expiration. So we got the 5th, the 12th, the 19th. That's the next open range day. So there we go. We've got February 19th here. There we go. You can see just underneath that open range. And so there's a new open range set. Okay, do we close above or below? We close above. Okay, that means long. And we go and run our perfect storm scan. And bang, identify long trades. Now, why do you think that this is such a timely thing to be learning? Because we just set open range on Friday. So that means that in the next couple of days, this is beautiful, because if let's say that what I'm saying today is correct. Let's say that we are at a bubble and we're just waiting for the timing for it to pop. And this has been just a short squeeze. Then where do you think we would want the resistance to be set? If you think of it this way, wouldn't it just be perfect that right as the market challenges the resistance from beneath, that's exactly where the key, most important resistance on the S&P 500 is set? That means that we set the resistance right at the top of the pattern, meaning we could then free fall from there if things break below. So this is very, very timely. So how do we take advantage of all of this? I keep coming back to talking about capturing the crash and then how we scan for opportunities. We've talked about a lot of data in today's presentation. We talked about the smart money, buying or selling levels. We talked about high yield bonds. I've talked about high probability patterns and so forth. And we've talked about open range. The whole focus of how we trade, and again, talking about what Andrew was speaking about before, how he looks at, if you could golf like Tiger Woods, if you could shoot hoops like Michael Jordan, or fight alligators like Crocodile Dundee, just to throw the Australian reference in there. Wouldn't you? And this is what we're doing here. We're detecting what are the big boys doing to find the stocks that we can then trade on. So whether you want to trade an option, an iron condor, whether you want to be selling calls or buying puts, whatever your strategy is to approach that setup, what we do extremely well, and this is all I've focused on for the last 12 years of my career, is building scans that will take all of this research, all of this data that goes into the background and puts it into a scan. So that each night, all I need to do is I say to myself, is the market is the market bullish or bearish? That's subjective, because that could be based on what you think Obama's saying, whether Trump's going to get into presidency, what the Fed Yellen's saying, what's going, blah, blah, blah. That's all subjective. It's all opinionated. That doesn't have any place in trading, especially knowing 70% of it is going to be wrong. So what do? We say not is the market bullish or bearish. We replace that question with is the market at support or resistance? Is the market, in other words, has the open range told us we should be going long, or has it been going short? I don't know anything else worth listening to when that alone is 80% correct. If I called you every day with a stock that I thought you should buy or sell, and I'm one of your buddies and I said, hey Jim, you should look at XYZ. And let's say that 8 out of 10 times I called you, it made money. Then don't you think that would be a track record you would listen to? If I called you again tomorrow, would you buy that stock? If 8 out of 10 times I was right. Yeah, of course you would. So when I know that this is 80% correct, this becomes the most important thing for me to bias my trades on. So Monday, Tuesday this week, we're going to look for whether it closes higher or lower, and that on its own will tell me whether I'm going to run my scan for the highest probability patterns to go long on, and that would be something like this. Celldex Therapeutics. Now they've got $5 May calls, or was 45 cents last time I checked. But this could easily rally to 6 if the market sustains bullish direction for the next 2 weeks. When you'll see the same pattern again and again, by the way. When the market broke open range positively in February, what do we scan for? We scan for longs. Oops, you may not have been able to see that chart actually. Let me bring that back up. There we go, CLDX. So that was the first one. This is one of the ones on my long list. KPTI. Another one. This is what you can see, that very similar pattern, that big swoop down, turns up. That was our entry alert. They're at $5.76 up to $9 now. SWM. Another one. You see the same pattern again and again. This beautiful swoop down, rally up. So that's not up as much, but that's up from 30 to 31, a bit of a slower mover. What else do we have? Is it EGL? I think it's EGL. Yep, that's the one. Again, look at the same pattern. Down, up, rally. From about 13 to 18 now. Our target's 1857. So now I've already taken profit on this. I took profit on this back here as we reached option expiration. So I didn't want to guess where open range was going to set, so I already got out of this position, but that's something we got into way back there. So it's again the same strategy, the same chart you can see again and again and again. So what we do is, one, we get the probability on our side with open range, and then what we do is we scan for the highest probability setup. The scan I'm showing you now is called Fallen Angels. It is in 2008 when the market crashed. It predicted 220, or scanned for 220 stocks. 75% of them went up in a down market. So this is a very highly probable scan looking for longs. Yes, that is Fibonacci's on the side. Now I'm going to run out of time here shortly, so let me tell you about the offer that we're going to give you today. And it's something that I'm going to have to change on the fly here, because it is, I'm going to throw in some extras that are not in the slides. So let's talk about that, and then we'll come back to some questions if we have any time left. We've got about 3 minutes left here. Okay, so as I said, the key focus of what we do is to utilize things that are measurable, things that are proven, things that have nothing to do with my opinion, only to do with results of what makes money and how often it does that. So when you're sitting there staring at the screen, and when you're doing your trading, you've got to ask yourself whether you're being efficient. You know, who's making more money? The guy making 100 grand a year working 60 hours a week, or the person making 60 grand a year working 10 hours a week? I would argue the latter. I became a trader to travel. I've just spent the last 4 months in Playa del Carmen, Mexico. The last 4 months before that in Australia. We head back to Canada next month. I don't have to be anywhere because technology can do the work for you. Now, I'm not saying go and travel the world or quit your job, but don't waste your time. You can do a lot by utilizing scans to take the noise out of your analysis. And this is what you can do here when you're scanning. So you can run a scan each night, going through and analyzing exactly what you need to look for. So what's the offer all about? We've got about probably 2 minutes left. We have put together a 4-lesson course on how to utilize everything I've just taught you into a strategy. So we're going to teach you how to go out and actually and give you the scans that we use every single day, so you can run that scan on your computer, and within seconds it will bring up exactly what the top selected longs are based on the highest probability patterns. It will tell you exactly what to consider buying, and you'll generally get maybe a list of 8 to 10. So if the market's above open range, you run the long scan. If the market's below open range, you run the short scan. Simple as that. We teach you the scans, and you can start using them right away. Now, all of that's covered in the first lesson. Yes, they work on TOS. The scans work on TradeStation, Thinkorswim, Metastock, Incredible Chart, TC2000. I may be missing some, but and if it doesn't work on your platform, we'll give you a scanning tool for free. Okay, so that's what's covered. So the first lesson, you'll get it straight away when you purchase today. You'll get the first lesson right away, and that's the important one to watch, because we are right around the corner from next week. So I would highly recommend getting that first lesson under your belt if you can before the end of Monday, let's say. Okay, so the other 3 lessons are going to go into application. So I can teach you, I can teach you everything about scanning, but what you need to know then is you need to make sure you are drawing trend lines the way that smart money algorithms do. If you draw the trend line incorrectly, then you're not going to see the correct pattern. Trend lines, in my opinion, are not subjective because they're not random. They're drawn with a certain process, and the smart money does it that way. We'll teach you how to do that. So the other 3 lessons in the course are how to take the scans and make a lot of money with them, what to do with the results, and make sure you identify them correctly. So 2 bonuses. The first bonus I had already planned to give you is that, obviously it might take a little time to learn strategies and become experts at them. So one thing we'll do for you is, depending on whether the market breaks higher or lower than open range, what we're going to do is we're going to give you the list, the top list of longs or shorts. So the ones that we've actually selected. Now these come from a list of over 500 stocks in a watch list that we have scrutinized with over 30 criteria, fundamental and technical. We've gone through the insider trading, the institutional trading. We've also gone through what the insiders themselves have been buying and selling in the past, and we've actually worked out what the track record was. So if an insider is buying stock now, what was his success rate over the last 2 years whenever he bought any other stock that he was an insider on? So we've selected the highest quality longs and shorts and created a video on exactly what those are. So whether the market breaks higher or lower, you're going to get this video that you can watch straight away with the work done for you. The final thing I'll give you before we have to finish here, the final thing that we will give you, which is something that's not in the slides, but something I will give you today, is a lot of people are asking about the open range, and I can understand why. It is amazing. There is a lesson that I recorded for our members, which is about 30 minutes long, 30, 40 minutes long. It goes over everything you need to know about open range, how to trade it, and it actually shows you all the statistics on the track record of the strategy. We don't sell that, we don't offer it, but it's something I will include for you today. For those of you who are purchasing, I will get that in for you at no additional cost. And yes, Roderick, it is a total of $97. So you never have to pay for this course again. You can access it as many times as you want, and you also will be able to practice this in our live classes that are also included this week, Tuesday and Thursday, where we will analyze the market live and answer all of your questions on anything you want to know about whatsoever.